Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Michael, thanks for joining me on the show, mate.
Owen, thanks for having me.
This is the first conversation you and I have had. We've just been talking for 42 minutes off air. There's so much to cover. I'm just delighted you could take the time out.
Seriously, my pleasure.
You've done a few podcasts in the past. You've spoken with Chris Judd, and you've also done some videos with Livewire, but I don't think anyone's covered the ground that we've covered. So our audience, myself, and pretty much anyone, I think, that hasn't come across you will be able to pick this up and learn new things, not only about investing, but about you and your journey and how that's shaped your philosophy. I'm not sure how familiar you are with the first question, but basically I want you to go back, cast your mind back to when you were a kid, growing up around money or business or finance, and kind of that early origin story for you and what triggered the interest in finance and money.
Okay, that's a good question. Look, I think it probably starts 2 generations ago. My grandparents came from Europe via the Middle East to Australia with almost nothing but the clothes on the back, and an exceptional work ethic. And I think that work ethic translated and was passed on to my father and their broader family. But along with that work ethic came a tremendous amount of support and encouragement for my father and my uncles and aunts to back themselves, to take risks and to try and achieve the most they can. And, through the 70s and 80s, my father, together with his sister, built up about a 14-store retail empire, tragically called Trendy Girl, very 1980s, tragic name. Whereas their brother ended up opening up a doctor's surgery, but again, he built it up, and they all became quite entrepreneurial. So we were always exposed as kids to that sort of thing. We used to help out, in the stores. We had a stall at the Queen Vic Market. We used to again help out, and if your listeners aren't watching the video as well, just
there's some air quotes in there.
There's some air quotes in the helping out in the working there. But some of my earliest memories were working at the Queen Vic Market for $10 a day. Did
that inspire you to did you I imagine you lamented it at the time, but now you look back on it, it was kind of formative?
Well, I didn't lament it. It was time with Dad. I mean, it was fantastic time.
Yep.
It wasn't like he was actually putting us to work. He'd help set up.
Oh, right.
And then we'd spend half the day sitting in the box on a pile of bags, relaxing, or serving customers, selling jumpers or T-shirts or whatever the case may be.
Okay.
So from a very early age, we got an understanding of what it was to work, what it was to do with customer service, what it was, what was money, what did it get you other than just buying stuff. Using money as capital to build a business. Of course, sadly for us, I don't want to make it sound too tragic, but sadly for us, late 80s, early 90s, saw basically an end to the Trendy Girl brand for my father. And we learned some important lessons. We learned the true cost of debt. We'd previously learned the lesson of working hard and the value of working hard. More than anything, I think through the late 80s, early 90s, we learned the value of having good people around you and the support of family. That despite what your challenges might be, if you've got the support, you'll generally get through. So that was some early lessons in terms of. So my first stock specific story was a gift of $100 worth of CSR that I was given by my aunt for my bar mitzvah. And I often joke that my business partner and co-founder Vas, his first stock was also CSR. He also got it at around about 12 or 13 years old. But he bought it 6 years after I did. So I often say that's the beginning of Vas proving to the world that he's a better investor than I am. So that was amazing. It was fantastic. Every time Mum went to the grocery shop from then on my instructions, the only sugar she was allowed to buy was CSR sugar. And it was, I had a sense of ownership. It was a cool feeling as a kid to be able to sit down and say, I own a part of this amazing Australian business. But my interest in investing more generally in stocks probably got started through an introduction to a broker at JB Were from my Auntie Jenny and her now late father, who introduced me to their broker. And it was quite interesting for me that, I'd get on the phone. This was pre-online broking. This was when you paid for your stockbroking services. I think we must have had a half an hour conversation about National Australia Bank, and then I walked away and bought some National Australia Bank at about $7 with some of my saved up money. And from then on, I started following it in the paper and, occasionally had conversations with the broker. And I realized that while information on businesses might be available to everybody, not everybody was as fully informed. I didn't quite know what to do with it at that point, but there was sort of the seed was planted that it seemed to me at that point that if you can be better informed than the market, surely you can make money out of it. So that was my earliest experience in stockbroking and in investing in companies.
What led you to then go and study?
What led me to go and study?
Yeah.
So my dream was to have a traditional sort of stockbroking relationship with clients, build up a relationship with the client, help them invest in the best stocks they could possibly invest in. This is at least what I imagined stockbroking was. Yeah. I've discovered with time that's not necessarily quite what it is, but that was what I imagined as a 14-year-old kid, 15-year-old kid. So the next step was going to university to get some sort of degree, either in commerce or in banking and finance or something along those sorts of lines. And so that's the approach I took. Little did I know that E-Trade and CompSec were going to put a dent in those sorts of plans, but I went along the pathway anyway, figuring that I'd work it out as I went. And it was good. We learned lots of important investing tools. We learned obviously how to read balance sheets properly. We learned all the different sorts of theories around financial planning. Little did I know, of course, that when I finally did find a job doing essentially what I was looking to do, which was fantastic, that I would spend the next 3 years mostly unlearning a lot of what I'd learned in university. So that was quite an interesting experience.
How do you mean? Can you recall any specific kind of theories or lessons?
No, yeah, for sure. I mean, I suppose at uni there was probably two aspects to what we were learning. Number one was practical analytics. How do you value a company? How do you discount cash flows? How do you read a balance sheet? And that sort of stuff is obviously key and super important. But the other half of what or at least in my day, what we were learning at university was how to diversify, how to de-risk, how to essentially take everything we've learned in the previous half of our education around how to value a company and discount it such that you can't possibly make a mistake because you're so massively diversified. And my view and value investing's view in general, and certainly Leyland Private Asset Management's view, was that no, we're value investors. We're looking to find and identify quality businesses that are better than the rest and invest in those businesses. So you've got to have a bit of conviction. You've got to have a bit of a concentrated portfolio. So, while I had the tools obviously to value stocks, a lot of that conceptual stuff around how to build a portfolio had to be unwound and relearned as a value investor.
For sure it does. I find that all the time, especially with young people. I think the abstract kind of ideas around portfolio management and all those types of things, just not only are they kind of deemed unnecessary by a lot of us later in life. Of course, you have to know the rules of the game before you can play it, of course. But at the same time, a lot of it is unlearned, and it's interesting that you put it that way.
I remember I had a university assignment where I took the view that I'd rather own less companies that I know better or that I think are better valued. And I had marks taken off for not having sufficient diversification. So that was the start of me going against the common consensus way of building a portfolio, I think.
Yeah, I think there is some, I won't name names, but I think there's some notable academics who, when asked how they invest later in life, had nothing to do with the theories or the accolades that they received, for those theories during their academic teachings and time. Those theories were actually thrown out when they actually just revealed what was in their portfolio. And so I think, maybe there's something to that as well. There is one point in your journey, which I think before we get to kind of your investment advice and dealing with that side of things, but the part where you've left uni and kind of what you did next, because I feel like there's a gap there which we need to talk about. There's
a secret gap there. Not so secret. I actually went to seminary. I traveled to the Middle East, to Israel specifically, and the plan was originally to spend a year reconnecting with my heritage, learning about my traditions and whatnot. So I went for a year, and a year became 3 years before I came back and started university. And I actually eventually went back again for another couple of years where I met my wife before we got married and built our family. So,
Fantastic.
So it's not quite your traditional pathway to funds management, but it certainly helped me. It certainly helped me in many, many ways, not just in becoming a better person, I think, but also in the way that I invest, in the way that I approach life in general, but specifically the patience that I have now and the ability to concentrate and get through a lot of the noise and nonsense that had I not gone through that experience, I might have struggled to have gotten through from an investment perspective.
Yeah. Was there anything there in particular that you think, you mentioned patience, but anything else, experience or anything else that you can draw on now that really benefits you?
I mean, look, I think, as I said, there's always been an entrepreneurial spirit in my family, and I think I've always had that entrepreneurial spirit as well. I think even before I knew that the word existed, thinking back to schooling in general, I remember back in primary school, I was selling Michael Jordan T-shirts at the height of the Chicago Bulls to my classmates. We bought boxes of basketball cards at wholesale price and then sold the packets to my mates at a discount to the retail price, and that worked well for everybody. I mean, I even remember my first ever arbitrage opportunity. I know this is a bit off topic, but I think it's a good story. Good. So I was at a mate's house on a Sunday, and we rode our little bikes down to the $2 shop because the concept of the $2 shop was pretty new, and what else are you going to do when you're 14? Yeah. It's not like you're going to go proper shopping. And we discovered that they were selling boxes of cricket cards for $2.
Yeah.
So we're like, well, that's pretty cheap. I'm pretty sure that the card shop down the road sells sets for like $10 a set. So we bought a couple of boxes. I think we had $4 each, so we bought 4 boxes. We took them home, we unpacked them, we made sets, and then we delivered them to the card collecting shop, the trading shop, and he bought our sets. So we took that money, went back, and ended up buying whatever was left on the shelf, and did the same thing again and brought it back. And this time the guy says, "Guys, what's going on?"
Yeah.
So he came clean because we were kids, and what are you going to do? He didn't give us the $9 I think he paid for the first set. The second time, I think he paid us $6 a set or something like that. But, clear arbitrage. Buy 3 sets from boxes for $2, sell them for $6 a set down the track. But, I've always been looking at ways to do things better, challenge the status quo. Is there a gap in a consumer need? And while I was in Israel, you can imagine that being in seminary is not exactly a life that generates much income. It's quite the opposite. It's not especially cheap to spend time in full-time study, especially overseas. But it's something I loved. So to help fund it, I would find little ways to make money. So, I was introduced at one point to a lady who was selling international phone calling cards. And this might sound like a foreign concept to some of your millennial investors and listeners, but back then, there was hardly cell phones or mobile phones, and if you wanted to dial international, you definitely needed to have one of these international phone cards. So, the lady who sold me the cards thought that, I'd focus on my school and, I'd go through X number of cards a week. I said, no, I'm going to make this work for me. And I ended up distributing to 3 or 4 other schools in the area as well. I noticed that other than having to walk down to the shops, there was no convenient snack foods in the school. So I organized for some vending machines to be put in. Probably the biggest project that I had was and these are all side gigs, obviously.
Yep.
The biggest project I had was, I think, a cleaning company that I launched. We had 60 staff at our peak, and we serviced about 500 families. And the way it worked was basically that in Jerusalem, once a year, there is a massive spring cleaning around the Jewish festival of Passover. And as a student, the first year I was there, I decided to sign up to be a cleaner. Again, not the traditional route to funds management, but this is my life. And so I worked for a cleaning company. They had a monopoly on the area, and I picked up a number of things they were doing that I didn't think was ideal. So I worked hard, and my clients all liked me and gave me their numbers and said, "Come back for a weekend. Would love to have you for a dinner, or next year would love to have you come back," and et cetera, et cetera. And I went back, and 6 months went by, and I thought, what? I made some decent money, and it helped pay the way, but this could be done better. So I said, I'm going to run my own cleaning company next season. And I ended up bringing on board my roommate, who had otherwise threatened to work for the other company and poach all of the local cleaners. So he came on board, and in year 1, I think we probably got to about 25-30% of what the previous monopoly had. We pinched about 30% of the pie. By year 2, we were pretty much neck and neck, and by year 4, I think we were probably the largest cleaning company of that sort in the region. Wow. So it was quite an experience. I think some of the main lessons that I would have learned from that I can apply to business in general, I think, is working a little bit smarter or a little bit harder can have massive implications on the end outcome. I think people would rather be comfortable than successful. I know it's a terrible thing to say, but I think if you ask most people, are you prepared to pay the price of discomfort to earn success or happiness? Most of them would say, no, I'm happy on the couch. I'm happy just doing what I know to do. And so if you do just a little bit more, if you go just a little bit out of your comfort zone, I think you can achieve more than people realize. I think we also realize that you can't build a business or an offering that you want. You've got to build a business or an offering that your clients want. So make sure that you're catering to the clients. I think perception as well. I remember in the first year, people would be wandering around the neighborhood in their cleaning clothes. And there are certain sensitivities in certain neighborhoods of Jerusalem, and I don't think it was fully appreciated. So, I suggested to the boys that would work for us that, come dressed and then get changed and clean and then get changed again. Again, it's a little thing. Maybe it didn't make a big difference, but again, if your reputation precedes you, then it's not going to hurt. And again, your reputation precedes you, for better or for worse. Your reputation will precede you. I think those are probably some of the key lessons that I learned specifically from that business that in many ways do apply also to the funds management business.
Absolutely. There's so many lessons. There's so many different threads that we could pull on, but I guess...
I think the main thing is, and again, I don't come from a traditional background in terms of taking the regular route into funds management, and I don't know what most people's life experience is from where they were to get into, say, a fund manager. But to me, it seems that if you're buying businesses, because that's really what the ASX is, that's really what the stock market is. If you're buying businesses, then surely you've got to be able to understand what makes a business. I was having a chat the other day. Someone asked me about Warren Buffett and Charlie Munger and where does their success lie? I'm not a big fan of quoting Charlie Munger, and I'm certainly not in a position where I can assume, what their strengths and weaknesses are. But I said to this fellow, look, I don't think either Mr. Munger or Mr. Buffett would claim to be able to read balance sheets better than the next guy. I'm sure you can find an actuary who can read a balance sheet better than Warren Buffett. I said, I think the secret to their success is that they understand business and they understand people. And when you're buying a stock, you're buying a business and its people, and that's key. So, I think the life experience that I've had in dealing with people and in running some businesses, and my business partner Vass has similarly had experience in running businesses as well and managing people. I think that puts us at a big advantage to perhaps a lot of people who haven't had that experience and instead have more theoretically looked at companies, through their balance sheets or through their reports or whatnot. So I think it's been a big advantage for us.
I see that all the time. It's not necessarily specific to funds management or fund managers, but just DIY investors, private investors in general. You often see a disconnect between, I guess, what they're analysing and what it takes to get to that level. So specifically what I mean is a lot of particularly newer investors, they think, look at the balance sheet, look at the income statement, and they might have learned this theoretically. But how do those numbers get there? And, I think, like you said, if you consider your strength to be the ability to analyse a balance sheet better than someone else, the challenge is it's not only actuaries you've got these days. You've got these supercomputers, you've got quantitative funds, and you really need to know where your strengths lie. But stepping back from that again, I think the quote, if I bring one up, and I don't think I've quoted Buffett on this one yet, on this podcast, but the quote that resonates the most with me is, I'm a better business person because I'm an investor, better investor because I'm a business person. And I think, case in point with you, you seem to have been a serial entrepreneur. And I think now you can apply that to analysing other businesses. It's quite exciting.
No, I think that resonates. I think that's a wonderful quote.
How about the next step in your journey, which was Leyland? What did you do there? And then maybe you can take us up to the formation of the Collins Street Value Fund, how you funded it, all those types of things.
Okay. Yeah. More interesting stories, fair enough. Leyland was a godsend, actually. Like I said, I was concerned with the invent of E-Trade and ComSec that I would end up a disgruntled office worker in the back of some big bank, crunching numbers and being dissatisfied with my life. But through a process of looking for a job, I discovered this boutique wealth manager out of Toorak that was essentially doing pretty much what I was looking to do. So I went in for an interview. It was, like I said, a small outfit. We were in a little office on a balcony overlooking the Safeway car park at the Toorak village. So it was very homely, but it was great because I met this fellow, Charles Leyland, who had a wealth of experience that I could learn from, who could take me under his wing. Again, it was Charles, myself, and one other person. So we got a lot of positive feedback and a lot of positive guidance from Charles. But what we did there was we ran what was called IMAs, individually managed accounts. And over time, I built my business, and over time, Leyland moved from Toorak to the city. And it got to the stage where I had some 30 odd clients. And the tricky part about an IMA is that every single client has a unique and distinct portfolio with a slightly different mandate. So it got to the point where, and it's on me, but it got to the point where I felt like it was becoming increasingly difficult to give the amount of time and attention that I wanted to each portfolio, and also, do some due diligence, some on-the-ground primary research on companies that we thought were interesting. So Vas, as I mentioned, my co-founder used to sit across the desk from me, and we got to talking probably in 2014. No plans, just talking about what our life might look like going forwards, and we came up with a suggestion that perhaps Leyland might be interested in launching a fund so that we can streamline things, we can scale it up, and we can spend more time focusing on identifying ideas and managing a single portfolio instead of being a little bit distracted. He wasn't interested, Charles wasn't interested, and that's fair enough. He'd built his reputation and his business on IMAs, and they are a wonderful product for a lot of people. In fact, a number of my previous clients, when they discovered that I'd launched the fund, they called me up and said, Michael, we're thinking about coming to follow you. Do you think it's appropriate for us? And I said to them point blank, no, it's not. No, it's not. I mean, our mandate is such, and your interests lay elsewhere. I think there's a tremendous amount of value in you having your own tailored portfolio, to achieve your specific goals. So it wasn't until 2015 that Vas and I left Leyland and underwent the process of launching the fund. The fund was funded mostly by savings. Again, we'd done pretty well for our clients, and so we'd been pretty well paid over the previous couple of years. But what got us over the edge in terms of funding was a relationship with BT Financial. Right. So I'll explain. Okay. I'll explain. We often found what we would call special situations, which was situations where a company had been battered for one reason or another, and there was an upcoming catalyst. We couldn't always know exactly when, but there was a soon-to-be upcoming catalyst that would see a re-rating of the stock. Maybe it's a takeover, arbitrage, maybe it's a in-species, splitting out of some of their assets, whatever the case may be. There were a number of these things that were attractive to my clients at the time, and so I spent some time focusing on that sort of area of the market, and we found a number of them. And one that we found was a company called Chorus. I don't know if you know Chorus, but essentially, if you imagine the wholesale side of Telstra in New Zealand. And the short version of the long story is the regulator there regulates how much they can charge for access to their pits and their infrastructure, and the regulator has two ways of valuing that. Number one, on the basis of what people in the rest of the world are doing, and there aren't many systems quite the same as New Zealand, so that's a bit of a challenge. And number two is go in there, work out what it costs to maintain at a margin, and on that basis, tell them what they can charge. So for their regulator there, it was much easier just to say, okay, we went out in the world, we found 3 other countries in the world that had something similar. On that basis, here's a price. And the company said, hang on a second, we're broke if that's the price you want us to charge, because you're comparing, New Zealand to European countries. It's not like for like, and our costs aren't the same. But the market didn't hear the complaints, and the market didn't appreciate that Chorus could go back and say to the regulator, no, we don't like that approach. Take the second approach, and that's the one that you have to, that's the one we'll go with. And that was the legislation. The market didn't realize that, and I think it fell from like $3 to $1.10, $1.20, maybe something. Right. So, somewhere in that vicinity. And we bought up as much stock as we thought was appropriate for our clients. And our clients were happy with it. Even as it drifted a little bit lower, they understood that we're in this until it gets sorted out. We thought it would take six months. It ended up taking 4 years, but that's a story for another time. But we got set, and Vas and I are sitting there, and we'd talked to the communications minister in New Zealand. We had ongoing dialogue with them. We'd spoken to management of the company. We'd spoken to some of the political parties that were against increasing prices for access to internet. It's not surprising why that would be a political issue. And we said, you know what, this is ridiculous. We said, we don't know if this is going to be resolved in 6 months or it's going to take 12 months. But this is a situation that is not sustainable. It's a situation that will be resolved. And this company is worth $3.50 to $4. And again, at the time they were trading about $1.20. So we reached out to a few relationships that we had. We were looking to buy an option against Chorus. So we ended up settling on BT Financial. And I guess their practice is that they work out what the risks are and they internally back the options, based on risk assessment. Mm-hmm. And they said to us, okay, fine, it's currently trading, I think at that point it was $1.40. We got options at $1.60. Break even for us was about $1.80. They said, what's the terms? How long would you like to be invested for? We've got like 1 month, we've got 2 months, we've got 3 months, and our longest is 6 months. We said, no. We said, we want 18 months. Yeah. So they said, okay, fine, we've got to create this ourselves for you. We can't find that in market, we'll create it ourselves for you. So they did that, and the risk was against their own balance sheet. And about 12 months later, as the options were expiring, the share price was about $2.60. We were very right, and we made some good money out of it. Mm-hmm. Sadly, almost immediately after we exited our options because they were expiring, it ran up to $3.50, but such is life, right? Yeah. And we did a couple of other similar option plays with BT until they cut us off. They weren't prepared to use their own balance sheet to back our ideas anymore. And if they couldn't find somebody to take the other side, they weren't prepared to give us the options, which is fair enough. But by that point, we'd accumulated some very reasonable savings, which funded the creation of Concentrate Value Fund, and also put us in a position where we were comfortable that if we didn't get fees for 12 or 18 months, that we could comfortably sustain the operations of the business.
Yeah, it's one heck of a story.
Yeah, sorry, it's a bit long-winded, but...
No, it's great. I tell you what, it's unique. I've never heard of that. So, okay, two things. Just tell us a bit about the strategy why you thought how, like, your experience and your philosophy added value in terms of, like, the strategy that you've chosen to pursue since then, I guess. And then maybe we're getting a bit ahead of ourselves, but it's kind of this natural segue to it, is why the fund has the fee structure that it has.
Okay. So, like I said, both Vas and I have done pretty well for our investors over time. And we received a lot of interesting feedback, especially through the GFC. So, as an example, I met with a client shortly after the depths of the GFC.
Right.
And, I'd brought his portfolio with me, and we were down about 5% against a market that was down 20 or 25%. And my expectations at the time, as I assume would be for most professional investors, was that he would be thrilled with a 15% outperformance against the index. I expected a ticker tape parade. I expect pats on the backs. I expect referrals to all of his friends. But instead, the client was dissatisfied that he was down 5%. Not I can hear that. I absolutely hear that issue. Like, the client was dissatisfied paying not a performance fee, a fixed management fee for a negative 5% return. And I said, well, what do you want from our lives? We beat the market by 15%. He said, Michael, I appreciate that you're not down 20%, but I can't eat relative returns.
Okay.
And so we started tinkering at that point with the idea of lower or no fixed management and performance fees only. And we discovered that it resonated with a lot of people, especially business owners and a lot of the high net wealth individuals that we'd met. It doesn't quite work or go down quite as well with the financial planning networks, because it's something a little bit different and a little bit new. But certainly it resonated with the entrepreneurs and the high net worth individuals that we met with.
Can I just ask a question? Why do you think the financial planners bulk at that a bit? Like, what do you think it is that they can't get their head around? Is it business risk?
Do you want my political answer or my honest answer?
I mean, I would like the honest one, but either. I'd take.
Look, I think a zero fixed management fee, performance fee only approach turns a lot of what the value add is from financial planners on its head. Once you identify a good fund manager, what's the additional value that you can provide to your client as an advisor that the client can't provide for themselves? I think the answer is pushing and getting a better price. And so if you can push a fund manager to give you a discount on fees, which you can then rebate to your clients, that's of tremendous value, and it's where they can see and where they can identify they're adding value. I think it becomes difficult when there's a zero fixed management fee and only a performance fee. And certainly from our perspective, we said, look, we're taking risk. If we make no money for you, we're not getting paid. And so we weren't prepared to discount the performance fee. And I think most people, that resonated and most people understood that, but at least from the professional services, from the financial advisors that we met with, they just said, look, this is a little bit out of the box for us and didn't quite suit what they were after. And that's fine. I think more and more as more other fund managers come on board with a similar sort of offering, I think it's probably getting better understood, and perhaps that there's more take up from these financial advisors than there were 5 years ago. But certainly when we started, people said we were mad.
You must have had, so I think there's a few things. Obviously, you mentioned that you did quite well before starting this, so you could afford it. But I think there's the other part of this, which is that you would have to have conviction that you will do well, and that you will do well for your clients, right? Like, you would have to be pretty confident in that.
Oh, of course you do. Yeah. But if you're not confident that you're able to add value to your clients, then what the heck are you doing starting up a managed fund?
Well,
what are you doing looking after other people's money if you don't know what you're doing?
True.
Look, again, I think our view, our value investment approach, our view that a concentrated portfolio is the best way to deliver the best results. It all sort of fits in nicely with the performance fee and the no fixed management fee approach to things. If we thought we couldn't do it, then we'd be out of, and if we couldn't do it, we'd be out of business pretty quickly. And, to be perfectly blunt, rightfully so. But our take was that if we did perform well, then we'd also get paid well, and it would be a win-win for both the clients and for ourselves.
Yeah, fair enough. So, value investing, I guess, 21st century. You've already mentioned, I guess, from the high level perspective, why investing works. But maybe you can step us through kind of your investment process and why, we'll get to some specific examples perhaps soon, but I guess why you think it still works and what you do day to day effectively.
Okay. Look, I think investing in general clearly works, given the time, given the right investment decisions. But perhaps one of the first investment books that I read was Robert Kawasaki's Rich Dad, Poor Dad. And it really put into perspective, if nothing else, that, and I'm sorry to boil down a 500-page page book into one line, but basically it boils down to make your money work for you.
Yep.
Make your money work for you. And you see that it's worked for a lot of people for a long, long time. And I believe that it still does work. But it's not easy. It's not easy. And as I said before, most people would rather be comfortable than happy or successful. And the effort that you need to put in to identify these good businesses, sometimes it's uncomfortable. I'm happy to tell you some stories about some of the things that we do that are quite uncomfortable to get the results that we wanted to get. But, sitting behind your computer and looking at the readily available public information, that's comfortable. That's easy. If you're doing that, then you've not got any more information than the next guy. What you really need to find in any kind of investment, no matter what your approach is, whether it's value investing, whether it's growth investing, whatever the case may be, you need to find some sort of advantage. And our take has always been, let's find an information advantage. If you can find an information advantage, you can identify good businesses. If you can identify what their appropriate prices are and they're trading at a discount to that, you can certainly make money. Now, I will grant you that between current price or mispricing and intrinsic value, there is some 5 million individual investors that are buying and selling stocks basically on the basis of how they feel when they woke up that morning. And so the journey from mispriced to proper valuation and generating a profit can sometimes be longer than you anticipate. But certainly, I believe that if you can buy a company or if you can buy an investment of any sort at a discount to its assets or a discount to its cash flows over the next few years, absolutely you can make money. And I think people intrinsically understand that. The question is, how do you identify those specific businesses and how can you have the conviction to back those ideas? And that's, I think, where the challenge comes in. And that's where we try and do the deep dive due diligence that provides us with that special insight.
Yeah. So I'll ask you about those examples that you said you have. But for those that don't know, it's the portfolio that you run is around 8 to 20 companies, but I'm led to believe it's probably at the lesser end of that, fewer end.
So the answer is yes, but not exactly.
Okay.
Our view is that you can have a properly diversified, and again, I'm using air quotations here for diversified because I'm not a fan of it for its own sake, but I think you can have a proper portfolio of 8 to 15 positions. I think that's probably about right. At the moment, though, we've taken a view on a couple of thematics, one being gold, one being uranium stocks. So we have more than 15 stocks, individual stocks at the moment in the portfolio. But if you lump together the gold stocks into one position, and we've created it as a basket, that's the way we think about it, and you lump the uranium stocks into one basket of uranium stocks, then we've got, I think, probably 8 or 9 positions at the moment.
Right. Okay. And so how about some of those examples? I find the investment process, and there's a chart which I can link to on the site. There's a few of them actually, which on your site, which I guess sum up and do the best job of just articulating the process really concisely. But one of the things that I think really works is an example. It doesn't necessarily have to be a company, but it could be. But kind of the things that made you uncomfortable to get to an outcome, to include it in the portfolio, to not include it in the portfolio. I think that really helps.
Yeah, for sure. I mean, look, the obvious things are asking tough questions of management when you get in front of them. You know, nobody likes to ask a tough question because it makes the other person feel uncomfortable and makes you feel uncomfortable. You know, one of the things that we tend to do, I'll just tell you a story. I'll give you an example. Yeah. So right when we were launching the fund, one of the stocks that we thought was going to be one of the first investments that we were going to make for the fund was Metcash. So at the time, the share price had fallen from $3 to about $1.20. The market hated it. The market said this business is finished. There's no way you can run supermarkets through a franchise system. It's done and dusted. Well, at the same time, management was saying, no, we've begun to implement these processes, these plans, which all made sense, and just bear with us. It's working. You'll see in 6 months. So what were the plans? The plans were, number one, price matching. There was a prevailing view in the market, probably still is to be honest, that IGA is more expensive than Coles and Safe and Woolworths. Let's price match to deal with that. Number two, a lot of the stores were disheveled and not especially attractive. Metcash agreed to give, not loan, but pay for half of any refurb that any franchisee wanted to make.
Right.
And number three, retraining. So again, I don't know how vast your IGA shopping experience is, but there are some exceptional IGAs. I'm talking they are better than the Coles and Woolworths supermarkets. They're just exceptional. And then you've got the ones that are, let's just call it less exceptional. So they implemented a training process to take best practices and spread it across the network. So management weren't saying this will work. Management was saying this is working. We've started a pilot program. We've rolled it out to a lot of our franchisees. And it is working. You'll start to see the results in 6 to 9 months. And the market said, nah, forget about it. So, Vas and I are there, we're thinking about it, we're talking about it, we had a chat with management, we understood what he was saying, it resonated, it made sense. We said, how do we know? How do we know if the market is right and this franchisee model is broken and it's not going to work? Or how do we know that management is right? So, Owen, sorry to put you on the spot. What would you do as somebody with a bit of business experience?
I would go to the supermarkets. I would ask around.
Correct. So we took off 2 days. We jumped in the car and we plotted out 15 IGA stores around Victoria that had taken up the early pilot program.
Mm-hmm.
So we'd turn up unannounced, would ask the cashier or somebody who was stocking shelves in the aisles to please direct us to whoever's in charge, the manager or the owner. And we went and just had a conversation, literally out of the blue. So we spoke to a lot of managers. We even spoke to a few owners of multiple stores. And the feedback that we got was overwhelmingly positive. We had one guy who was sitting, and he called us up to his office and he sat us down in the chair across from him. And he was on, I guess, a morning meeting with some of the other supermarkets who are a part of his ownership, group. And he was half talking to them and half talking to us, which was a bit strange, but it was what it was. And we were asking about what sort of returns have you seen from your refurb? And he turned his screen around to us and showed us, his store specific, how sales had improved, especially in fresh fruit, it was at the time, fresh produce, since they did the refurb. And we said, how's the feedback been about price matching? And he went on about how exceptional it was. And the story was, throughout 14 of the 15 stores, almost to a T, the same. This has been revolutionary. This has been amazing. Not only have we seen exceptional returns here, but when we get together with the rest of the IGA supermarkets at our biannual conference, I think it was in Queensland that year, the feedback was so positive that despite the fact that management of Metcash were planning to roll it out over 12 or 18 months, everyone who we spoke to expected it was going to be done in 6 months because the results were so exceptional. So we went back and we said, well, it's not a question of does this work or doesn't it work? We can see patently from the primary research we've done, from speaking to people, that it is working.
Mm.
So we said, you know what? We're happy to start buying some of this stock now. So, we bought a little bit, the price went down, we bought a bit more, price went down some more, we bought some more. And the challenge I think that a lot of investors have, especially with the share price going backwards, is that if you've got nothing to judge your business on except for its share price, well, if it drops from $1.80 to $1.20, it's suggestive that you're wrong. But if you know what's going on, then if you started at $1.80 and you can buy it at $1.60, well, bonus, we're getting the same business for a cheaper price. If it goes to $1.40, even better. At $1.20, oh my goodness, what a special treat for us.
Mm.
So that's the approach that we take and that's the approach we took. And of course, it worked out very, very well and Metcash went on to flourish. The one store that didn't give us quite as positive feedback was an interesting situation. We walked in, it was a gorgeous IGA, actually. It was a beautiful, big IGA. I think it was somewhere in the inner eastern suburbs, or southeastern suburbs. And we went in and we did the same spiel that we'd done every other time. We went to the checkout lady and we said, can you point us to a manager? And normally they'd point you to an office somewhere and we could see, it was a multi-layer building. You could see from the ground floor, there were other floors where management clearly was. But instead of pointing us to an elevator or something, she pointed us to a fellow who was checking prices in the aisles. So we went to this guy and I gave him my card and I said, this is Michael, this is Vas, do you have a couple minutes to have a chat about, the price matching policy and how it's impacted sales, et cetera, et cetera, et cetera. And again, he might have qualified as manager, but I suspect it was pretty low level manager.
Okay.
He immediately got his back up. He was very, very confrontational. And he essentially escorted us out of the store, accusing us of being competition, trying to spy on the IGA that he was the manager of. We got to the car, and I'm sitting down, and Vas is grinning from ear to ear, and I'm shaking. Like I've never been chucked out of a supermarket before.
Yeah.
The biggest confrontation I had in my family is who gets the last schnitzel at dinner. That's the biggest confrontation. I turned to Vas. I said, Vas, why are you grinning? He said, mate, we've been doing this for 2 days. Every time we walk into a shop, they tell us almost the exact same thing. This is the first thing that's happened that makes it a story worth telling. I said, fine, way to see the silver lining.
That's great.
So again, it's not comfortable necessarily to rock up unannounced and ask to speak to the manager. I feel like a Karen all of a sudden. I'm not asking to speak to the manager for a negative reason. I'm going out of my way and trying to find information that's available to people who are prepared to make the effort, but most people don't. And we asked, we said, has any other brokers, have any other fund managers come and talk to you guys about your experience since implementing these new projects? And not a one said yes.
Mm.
We don't understand why not. We can't understand how something that seems so simple to us and so obvious to us isn't something that's being done by everybody else. But I suppose therein lies the opportunity. If everybody was doing it, if it was easy, if it was comfortable, then there would be no mispricing. So I guess we're fortunate and thankful that not other people aren't doing it or weren't doing it. But yeah, I mean, that's a sort of example where we try and find that information advantage. And again, you know, we've owned companies like ANZ before. You know, walking into the Burke Street branch and asking the cashier what their till looks like and how business has been going is probably unlikely to give me the sort of feedback that I want. I think getting kicked out of an IGA would be a positive experience relative to what might happen if I'd asked some of those questions. You know, each business, obviously, there are different angles that you can take or different avenues that you can approach to get that advantage.
I got, and I think this is just great, I got fed a question from Rob, who asked me to ask you, and I think this is relevant now, is what's the strangest thing you've ever done to get these insights? Or like the most unique and memorable experience that you've had?
Okay. To get information on a company or suggest it to a company? To get value. I guess the strangest thing that we've ever suggested to a company to help realize shareholder value was a small company called Litigation Capital Management, who essentially financed litigation, who were not being they were not being appreciated in the Aussie markets. The Aussie markets don't get the business, and that's fair enough. I actually tend to think, and I don't mean to disparage anybody, and that's certainly not my intent, but I tend to think that if you go outside of the ASX top 50, you know, if you go outside of banks, if you go outside of BHP, if you go outside of Woolworths and Telstra, you know, the Australian stock market isn't as sophisticated, I think, as we'd like to think that we are. So a company that is providing a service that is out of left field relative to what people are used to, I understand why it gets discounted in the markets. So we were getting frustrated because we'd owned it already for 12 months and it was a great business and it was just not being properly valued. And we had some conversations with management, and one of the things that cropped up was, you know, if it's not working in Australia, you're doing everything that could be asked of you. How about going to London? How about going to the UK markets where they have some more of this sort of stuff? And the company did end up doing that, and the share price reflected that move and that better understanding of that industry in the UK relative to Australia. That was probably the strangest thing we've recommended to a company. In terms of the strangest way that we've ever done research, I'm a bit hesitant to say.
Oh, it's got to be juicy then.
So during COVID-19, prior to COVID-19, we've been concerned about the economy in general. And so, you know, we've steered clear of a lot of consumer discretionary sorts of investments. Yeah, if you have a look at our portfolio, I think it resonates when you have a look. But one of the most recent pre-COVID ideas that came through was from Vass. He liked a company called National Tyre and Wheels. And he made the case that it is counter-cyclical because when you're not selling new cars, and since 2017 you've seen a decline in new car sales, massive decline in new car sales, then, you know, you're fixing parts, you're replacing tyres, you're replacing wheels, you're getting a paint job. And he made a case that National Tyres would be counter-cyclical and so a good stock to hold. So we bought some. And, you know, it was pretty steady through the Corona crash, and it went down a little bit, and I think it went from 40 cents down to low 20s. And I still believe that's because, you know, it made sense. I wasn't 100% on board, but it was sound enough. But during homeschooling, so my daughters, I've got twin daughters who are 14, they were doing an economics project, and because Dad's in the industry, every time they had a question, you know, on economics or finance or whatever the case may be, they came in and asked me, and they said, "Oh, we've got a project now on assessing the impact of COVID-19 on local businesses. What should we do?" And I had you know, a light bulb moment. I said, "You know what? Let's do research together." I said, "Let's do some investigation into wheel and tire companies. It'll suit your project, and it'll suit my ongoing due diligence into a company that we already own." So we took turns between my daughter and I. She had her standard questions that the school had given her, and I added a couple extra ones in. And we called 6, 8. Let's call it 8. It was 8 different stores we called. Some regional, some more inner city, some in Queensland, some in New South Wales. My daughter spoke to 2, of the people that we got through to, and I spoke to the other 6. And we discovered that things weren't quite as bad as they were bad, don't get me wrong. But the market was anticipating a wipeout of 80% or 60% of tyre sales. And the feedback we got in researching my daughter's project was that no, it was bad, sure, but it was down about 30% across the board. And they'd started to see an uptick in sales, especially as it related to what are called RVs, like motorhomes and things like that. Especially in regional Queensland, they had actually seen a boom in sales. So I've never before enlisted child labour in my efforts to get a competitive advantage, but I will admit that when we got through, people were far more prepared to talk to my daughter than they were to me.
That's great. I think it's a fantastic story. I think we don't often talk about the lessons that are then placed back on our children and the things that we teach them. And I think implicitly that does that. So it shows you how you can teach them to invest like you, to think like you, to think in terms of business. So I think that works brilliantly.
Yeah, 100%, because I could have just told her the answers. I could have done the research myself and then, passed on that feedback. But I think, again, it's perhaps uncomfortable for her, but it's a great lesson learned. And, she went out of her comfort zone and she grew as a person because of it, and she got some great responses as a result as well. But
that's great. As long as she got the good marks.
Yeah, she did. She got an A.
No credit your way, but
no. Look, she went off and she wrote her report, and I went off and I wrote my investment committee meeting notes, and I took it to the table, and we ended up actually adding about 50% of our position on the back of those conversations.
All right.
To that particular stock, which was quite fortunate in the timing, because about 2 weeks later, the company came out and said, "Hey guys, I know you're all scared that we're wiped out from coronavirus, but it was a tough month, but we're down 30% and we're starting to see a massive recovery in tyre sales now." So, we heard almost the exact same story from the listed company through their announcement as we'd heard from the individual stores that we personally called. So that was pleasing.
Yeah, great. That probably leads us into the next question, which is about portfolio construction and how you think about weightings across companies, and I guess the reason for 8 positions. We talked just before this about how you seem to have this brilliant recall when you talk about companies. Like, all the really important facts, the really important numbers, and you can tell the story really well as if you own the company. So I can only imagine that plays into your thinking, having that informational advantage. It's easier to do that on 8 to 20 stocks than it is to do it from 20 to 50 stocks.
Yeah, I'm rarely the smartest man in the room, so except when I'm at the table with my wife and daughters, then I am the smartest man.
Don't let her listen to this.
Look, I suppose it all comes down to how you define risk. And I think the greatest risk comes from making mistakes or not knowing what you're doing. So when people are talking about diversification, they're not talking about reducing risk. Right? Risk is the concern for losing your capital, absolute loss of capital. What diversification does is reduces the volatility of your portfolio. And to me, I'm not especially concerned about volatility. I don't write it off entirely. I don't run my fund in the same way I would run my personal money, because for my personal money, I'd be happy to own 2 positions or 3 positions, but I recognize that that's not digestible for most people out there. And so running the fund, we've picked, the 8 to 10 positions. But if your concern is risk, which is what my concern is, why on earth would I put more money into a company that I'm less confident in just to reduce volatility? Like, that sounds absurd to me. If we like a business, if we like an idea, we're going to put 5 to 10% of our capital in that idea, because you've gone to all the effort to understand this business. You've gone to all this effort to find the stock to buy it. Why on earth would you stop at 1% or 0.5%, as many funds do? 2% if you're going crazy. If the company doubles, so it's added 2% to your NAV at the high end, like that's not going to have an impact. So what we've done is we've said, look, we are conviction people. Yeah. We are conviction people. We invest in businesses that we like. And when we get it right, which is thankfully more often than not, we'd like it to impact our returns. And so we think the 8 to 12 positions is an appropriate place to be, to make our investors comfortable that they're not seeing massive swings in volatility, but also doesn't expose us to the true risk of owning something that we don't properly understand. And again, I think the true risk to investing is not how much volatility you might see from day to day, but the true risk to investing is making a mistake and losing money. And the first rule of investing is don't lose money.
Yep, it is indeed. I think that's great. I think we share a very similar philosophy there. But I think it's also unique in our industry, and particularly in funds management, because you can do it because it's your fund. Like for everyone, it's their fund, but for you, it's your fund. You invest in the fund, like you own the business that controls the fund. So you invest in a way that is reflecting your experience and what you believe works. Whereas some managers get in the position where they have other competing interests, right? And that can be a bit of an issue.
Yeah, for sure. I've spoken at length with other people before about what differentiates our fund to many of the other funds out there. And I always come back to mandate. Again, I don't think we're doing anything materially different from working out what a valuation is. I suspect that most people have similar sausage machines where you input the ingredients on one side and it comes out with a price tag on the other side. I think the main difference is that our investors are backing us. And in doing so, they allow us to have a concentrated portfolio. And if you're investing in your best 5 ideas, then you're likely to do better than if you were spreading it around 20 or 30 or 40 or 50 different ideas. So again, you're 100% right. It's the mandate that we've received from our investors that allows us to do what we're doing.
I think too, like if I could zoom out and think over time, the focus on zero management fee, I feel like maybe I'll let you answer the kind of the implications for the industry at large if more funds go towards this. But I feel like the way you've set the fund up and how you invest in a more concentrated manner is reflective of that in a way, because there are you and Vass and a small team around you that help you make decisions and research and run your business. I feel like that's only possible when the fund itself is lean and it's focused. And do you share that sentiment? And I guess what are the kind of implications if more funds go to this type of, model?
Our view has always been that we want to find management of companies that have aligned their interests with shareholders. And we think it's reasonable that our investors would be looking for the same thing. So when we sat down and we thought about how can we most align our interests with our investors, the thing that came to mind was, well, if our investors don't make money, we don't make money. And I think that makes some sense. What that means, though, is a number of things. It means, number one, you need to have, again, that mandate. You need to have the capacity to do what you believe to be right. In our case, that is run a concentrated portfolio based on the principles of value investing. But it also means that you've got capacity constraints. And in a space, the financial world, that's dominated by funds trying to get bigger, because in ordinary circumstances, the bigger you are, the more fees you can make. Our fee structure just doesn't work. Because at the point that we grow too big for our britches, well, we're not going to generate those performance numbers that we want to generate. And if we're not performing, if we're not generating those positive returns, then we're not getting a fee. So I think what you would find, and I'm not aware of a big wave of zero fixed management fee fund managers coming out, but I think if you were to see that, I think what you'd find is probably one of 2 approaches from fund managers. Certainly you've got to keep it lean, because you never know when your next paycheck is coming. I think number one, you would find that funds would be far more active and far more aware of their constraints, which is great, because then you've aligned your interests with your unit holders, and everyone's going to do well. I suppose the risk is that you could become overly conservative, and if your fees are based on the absolute return, well, you could stick all your money into cash or term deposits or some version of a hybrid or a bond and generate a very low return, but you would be able to scale it up much larger, and you'd get performance fees on an ongoing basis. I think the trouble with that second proposal is that we don't live in a vacuum. And if someone were to give an equities fund manager money to invest in equities and then discovered they were instead sticking it into bonds or cash, I think that fund manager would probably go out of business pretty quickly. So I think it would be a positive for investors if you saw more zero fixed management fee funds cropping up. But again, it's a risk. It's a big risk from a fund management perspective, from a fund manager perspective, to make this offering. Because number one, you've got to back yourself, and number two, you've got to be able to support yourself. And again, we were fortunate that when we launched the fund, we had a number of people who said they would support us with an investment in us. We were fortunate that we'd saved up some money through some good investments over the previous couple of years. And we backed ourselves from an investment perspective because we had, in my case, 8 or 10 years of positive track record, and I thought we could move that across to a fund structure as well. So a lot of stars aligned for us, and both Vas and I are the sorts of people that are prepared to take those sorts of risks, to back yourself, and to chase our goals, chase our dreams, as cliche as that may sound. I don't know if there are many other fund managers out there that would be prepared to take that risk, and at least so far from what I've seen, not a lot have. So I don't know. That's I suppose my.
I guess we'll wait and see with that.
We'll wait and see.
Yeah.
Look, the risk is a race to the bottom. Right? You've seen it in fixed management fees. You've seen in fixed management fees that fundies used to be able to get away with 2 + 20, and now they've dropped their performance fees in a lot of cases, and they're being squeezed down to 0.2, to 20 bips instead of 2%. So I suppose if it became common practice, and I can't imagine it being the case, that funds started moving to performance fee only, that there'd be a race to the bottom there as well. But again, I think that's unlikely. It's a bit like cutting off your nose to spite your face. It's not gonna be helpful.
Yeah, and of course, I guess we should mention that it's not the only consideration that people should be thinking about when they're weighing up a fund.
If someone is deciding where to invest based on fees, they probably shouldn't be investing, right?
Yeah.
So, we want people to back our philosophy, yeah? But at the end of the day, it's easier to compare something that you can see in front of you than something theoretical. So our philosophy and our process is somewhat theoretical for people who are not us, for people who we're looking to bring into the fund. Whereas fees and returns, you can see them spelled out, on the Morningstar website, on the Mercer website. You can see and compare like for like. At the end of the day, our view is back philosophy, back results, in that order. The fees impact the results. So that's about as far as it really should go. Again, our fees are different, so it's a bit of a marketing angle. But at the end of the day, if you're investing for the fee structure only, you shouldn't be investing with us. You should be backing us for, number one, our philosophy and our process, and number two, if you think we can continue doing the sorts of results that we have been doing.
I think a lot of the people that listen to this know why I structured the series the way I have, insofar as the questioning. But maybe for some of the listeners that don't, the reason why I don't ask people, what's your take on this, or how was your quarter, or whatever, is because in my mind, as someone who invests longer term, the really important questions are the questions that are formed how you think. Because if you invest with someone, you invest alongside someone, what you're getting is their process and their philosophy. You're not getting what happened in the past. And that's why I spend so much time on that, and I want to learn more about you.
And that's why I say philosophy and process first, and return second, because we might have a great month, we might have a terrible month. At the moment we're flying high, but God knows in 6 months' time we might not be. So we're very conscious that when we bring in investors, that they're not just coming in because we've done well. We're very conscious that they understand our philosophy and process and they buy into it. We don't want fast money. We want people to come and back us. And so far we've been fortunate that that's been the case, and it's been shown through the Corona crash. Thankfully, we didn't have any redemptions during the Corona crash, and it's not because of our results, because we were down the same as everybody else, but it's because people understand what we're doing. And if you understand what we're doing, and and you support it, then you back the fund.
For sure. It's more sticky, isn't it? I didn't know you were going to bring this in. For people that are on the podcast, you don't know, but there's actually a book in front of me. From the camera, you can see this. There's a book here that you created a few years ago with all of your favourite quotes in it. And you've put a couple of your own in here. One from you, which is, you can get rich slowly or you can get poor quickly. Timeframes and outcomes really cross over. I was going to just get you to explain that, but I think it might be obvious, but maybe there's something in there.
Might be obvious. Look, the best quotes are the ones that aren't obvious in hindsight, right? Look, I can't count how many times I've spoken to, especially young people, and they've said, Michael, what's a good idea for me to invest in? And I said, look, I can't provide you specific advice because I don't want to go to jail or lose my license. But something like ABC, let's say. And they'd inevitably go off and buy ABC despite it not being financial advice. And they'd come back 12 months later and say, oh, it was boring. I said, what do you mean it was boring? It was up 25% in 12 months. No. I need 100%, 100% in 6 months. So I think people underestimate, I'm certain of it, people underestimate the value of compound returns. Yeah, perhaps by itself, 20-25% per annum might not look like a lot, but over a couple of years, all of a sudden, you've doubled and tripled your money. I think on the flip side, people don't tend to lose money slowly. So I think people tend to make dumb mistakes and get wiped out. So I think the idea of that quote, getting rich slowly or getting poor quick, is that getting rich is a slow process. Getting poor is the easiest pie.
Yeah, I think it's like if you get rich quick, just take away the quick and just focus on get rich, and then your time frame will shift.
100%. Yeah. I mean, there is one philosophical point. I know it's non-consensus for me to say this, but I do appreciate that for some people, time frames are different and expectations of returns are different. And I'll tell you what I mean. It's just something that I've thought about for a while, and I haven't quite come to grips with it, but it's an interesting point. But I call it an internal inflation rate. And what I mean by that is, if you're a young person and you're looking to invest, traditional advice would be to invest pretty much in the same way that your dad or your granddad would. Yeah. You can be pretty confident that 60 to 80% of people who you go to for financial advice, whether you're 20 or whether you're 60, are going to suggest that you go and buy an index fund because it's easy. I think it's a mistake. And this is totally counter consensus, but this is my view. My view is that as a young person, your internal rate of inflation is significantly higher than your father or your grandfather. Why? Because for a 12-year-old, $100 is the entire world. Yeah. For an adult, $100 is the first half of your day at work. So for a child of 14 or 16 or 20, to ensure that their investments are keeping up with their internal rate of inflation, which is much, much quicker than their parents or grandparents, they probably should be investing in stocks that have a greater prospect of higher returns, although they also have the higher prospect of risk of loss. And the point being that it's worth taking that risk because even if they get it wrong, their earnings capacity is ever increasing. So the $100 that to them was their whole world at 14, at 16, it's suddenly just a weekend at work. At 18, again, it's suddenly just, a day at work. So my view is, while I encourage people not to try and get rich quick, the definition of quick, I think, for different people at different stages of their lives it's got to be treated differently. And I think it's a shame that the industry doesn't really deal with a 20-year-old and a 60-year-old sufficiently differently.
I think I find that with entrepreneurship in general. For example, if you had a negative experience with one of your smaller entrepreneurial endeavors when you were younger, that would be okay because you had so much time to recoup. but you should have taken that risk regardless of the outcome.
The lessons learned are worth far more than any money you've lost in your younger years.
Yeah.
Absolutely.
Yeah, and without that experience, you wouldn't have been molded into the investor that you are today. Okay, 2 more questions because I know this has gone on for a while and you've got other things to do in the day other than
I
just
told
talk
you,
to me.
my car is locked in for another 2 hours, so take your time.
So this one's an easy one, which is how can people learn more about you and the Collins Street Value Fund?
The best way would be to reach out to us via email. You can get us through office@csvf.com.au. Equally, you can check out our website, again, csvf.com.au, and there's contact details there.
Yeah, I'll put some links in the show notes for sure. Last question, which is one of my favorite. If you could go back, tell yourself one thing, maybe there's more than one, but one really important thing about money, life or investing, what would it be?
So I think we talked about it earlier. I'm not sure if it was on camera or off camera, but I think a couple of the most important things, and some of them I did, some of them not, would be number one, find a mentor. Find a mentor that you can lean on and you can learn from. That's fundamentally important. You don't need to reteach yourself everything from scratch. You can find someone that can be your guide. Number two is find a friend. I don't mean a mate. I mean a friend an industry friend, somebody who you can test your theories against, somebody who you can push against, someone that you can be devil's advocate against, someone who will help you grow. Both of those roles are distinctly different and incredibly important.
Yep.
I think the other thing is have patience. There's always going to be another idea. I recall as a youngster seeing an idea and getting excited about it and thinking, this is the greatest idea that's ever happened and ever will happen. It's never the case. It's never the case. There'll always be another opportunity. Don't jump at something until you've got conviction. And on that, I suppose, finally, would be when you have conviction in something in life. It doesn't need to be specifically in investing. Whether it's, a person in a relationship, whether it's, a sports club that you want to commit to, or whether it's an investment that you've discovered. Once you've got conviction, don't be fearful. Act. Act with conviction. I think those are probably the four main things that I would tell myself and my children. And get a watch.
A watch?
A watch, yeah. I think time is the only thing that you can't make more of, and it's your greatest asset. It provides you the greatest power for self-growth, and yet you find people frittering it away. And certainly for children and young adults, they're often even totally unaware of that time as it's flittering past. So get a watch.
There's some great ones in there. Michael, as always, mate, thank you for your time.
My pleasure. Thanks for having me, Owen.